I'm Matt Bichard with REIT.com here in La Quinta, California for REITWise 2013, NAREIT's Law, Accounting, and Finance Conference. Joining me is Jim Sullivan, Managing Director with Green Street Advisors. Jim, thanks for joining us.
Good to be here.
As the first quarter nears its end, how would you sum up what we've seen so far in the REIT market, and have there been any surprises?
I'd have to say that the so-called junk rally is at the top of everybody's mind right now. When I say junk rally, I'm really talking about smaller REITs that generally own higher cap rate properties and generally have more leverage than the average. Those REITs have performed exceptionally well relative to the blue chip companies, and that's been a source of a lot of confusion, a lot of investor angst, and we get a lot of questions. What's going on here? Why is this happening? And I have a couple of theories. I can't tell you exactly why it's happening, but one theory is that we have an entire investor universe that's searching for yield, and it's found that yield in some of these smaller REITs that have higher dividend payouts. We also have heard the theory that you have some generalists that waded into REITs, typically bought some of the blue chip names, and have now decided to take their capital elsewhere. And so they've been selling the blue chips, putting downward pressure on those shares. I'm not sure exactly what's happened in the short run, but at Green Street, we've done a lot of work that shows that REITs that own high quality real estate and run their balance sheets with lower than average leverage almost always win in the long run. You haven't won over the last couple of months, but if you're making bets for the next couple of years, blue chips versus smaller companies is probably a good bet right now.
And M&A is always a hot topic in the REIT space. What's your stance on what we're going to see there?
When I think of M&A, I think there's really two questions. What should happen versus what will happen. And what should happen is that we have too many smaller REITs in our industry. We have a lot of companies with $1 billion or $2 billion in assets. And we think the market really underappreciates the G&A burden for these smaller companies. It's very expensive to be a public company, and if you're a smaller company with a smaller amount of assets, it's hard to spread those G&A costs across a small asset base. We have a lot of those companies. They should combine. They should get to be bigger. So that's what should happen. Now, what will happen is a different answer. I think what will happen is we'll see a lot of speculation. We'll have a lot of who's going to buy who discussion. But I think at the end, you have a lot of founders who don't want to be sellers. You have a lot of structural impediments in the REIT business that prevent hostile deals from happening. So I think there'll be a lot of discussion and not a lot of action. The primary exception to that statement is in the non-traded REIT world. In the non-traded REIT world, you have a lot of activity right now promoting M&A. This is an industry that's going through a very rapid evolution, and the M&A that we are seeing is really dominated by the non-traded REITs and what they're doing.
Now, listed REITs have benefited from their access to various forms of capital. What changes, if any, do you envision in REITs' approach to the capital markets, say the next 12 to 24 months?
Real estate's a very capital-intensive business, and those that have the lowest cost of capital have a giant advantage over those that don't. And REITs are the beneficiaries of very low-cost capital right now. Debt is cheap, preferred equity is cheap, convertible debt is cheap. Common equity is cheap for a lot of REITs. And the REITs have been doing a terrific job in many cases of taking that cheap capital and shoring up their balance sheets. And in some cases, the REITs have done a terrific job of using cheap capital to grow their balance sheets and grow their assets. And I don't see that really changing over the next 12 to 24 months. I think it's a terrific environment for REITs to take advantage of what the market is giving them, cheap capital.
And lastly, we've seen a number of new property types emerge in the REIT universe. What's been the investor reaction to these new companies?
The investor reaction has been, I would say, mixed. I think there's a lot of concern as to what constitutes real estate. And as you get further and further from the real estate, when you think about a company's value, if more and more of the value is concentrated in the operating business and less of the value is concentrated in the real estate itself, I think investors are going to get more and more squeamish as you move to this end of the spectrum. An anecdote that I like to tell investors when I think about these new converted companies and are they real estate and will they ever be real companies, I look at HCP. And HCP, as you know, is one of the blue chip names of our industry. It's a top 10 REIT by equity market cap, a blue chip by so many definitions. That's HCP today. But I'll take you back to 1985 when HCP was formed as a spin-out from a healthcare operating company. It was a tiny company. It was externally managed. It owned hospitals and nursing homes, which were brand new property types to the REIT industry. And from 1985, sort of this laughing stock company evolved into a blue chip. So to the REIT conversions today, I don't know which, if any, of these companies will be the HCP anecdote of 20 years from now, but I do encourage investors to be at least somewhat open-minded that a little nursing home hospital owner in 1985 can become a REIT industry blue chip, that some of these companies may follow a path that's analogous.
Jim, thank you so much for joining us.
My pleasure.
For more on this and other REIT news and analysis, be sure to visit REIT.com.